Okay, let's dive in. We're unpacking the Q3 2025 earnings call for Spectral AI. This is the AI-driven MedTech company, with the DeepView system for assessing burn wounds. The call was after hours, November 11th, and it felt pretty critical. We're looking at their financials, but really, it's all about the regulatory story.
That is the whole story right now. If you were tuning into this call, you weren't there for the quarterly revenue number. Spectral AI is deep in what we'd call a bridge quarter. They're trying to get from being a research company, funded by big government contracts like BARDA, to a real commercial company.
Right.
So the market was looking for just two things, really. One, is the FDA process still on track? And two, do they have enough cash to actually make it to the other side?
And our mission today is to figure out which story won.
Right.
Was the good operational news enough to, outweigh some pretty rough-looking financials?
Exactly. Let's start with those headline numbers, the ones that caused that immediate sort of cautious reaction.
Okay, so GAAP earnings per share, they missed. Pretty significantly, actually. A loss of 13 cents versus the consensus, which was looking for a loss of 8 cents. That's a decent-sized miss.
And the revenue just added to that feeling. They came in at just under $3.8 million, all of it R&D revenue.
Yeah.
The street was looking for over $5 million. But the really eye-popping number was the year over year. That revenue figure, it's down 54% from the same quarter last year.
54%. I mean, a drop that big would normally send a stock into a tailspin, but we saw a modest dip after hours? Maybe 3.5%? That tells you investors already knew the context here.
They had to. The market isn't looking at that 54% drop as a business failure. Not at all. They're seeing it as the a necessary cost of the pivot. They finished the really expensive high reimbursement work for the BARDA contract. That's what drove those big revenue numbers last year. Now they're just waiting for the FDA. The whole valuation of this company hangs on that one regulatory step, not this Q3 print.
Which brings us to how management is framing this pivot. They kept coming back to this three-part mantra: finance, focus, and finish. Let's start with finance, because, no matter how good your tech is, if you run out of cash, the game is over.
The liquidity check was priority number one. And at the end of Q3, they had a pretty strong cash position, $10.5 million. But the really interesting part, the thing you have to notice, is what happened after the quarter ended. In October, they went out and raised another $7.6 million through an equity and warrant financing.
Okay, so on the one hand, that's smart, shoring up the balance sheet, but for you, the investor, that's dilution. Doesn't it seem a little concerning that they raised money right after reporting $10 million in the bank? Does that mean their burn rate is a little hotter than they're letting on?
And that's the tension in this whole story. Management's line is that it was opportunistic, that this new capital gives them enough runway for the foreseeable future, definitely enough to get the U.S. launch off the ground. They see a little dilution as just, the cost of doing business to make sure they cross that finish line. But yes, it was a signal. It told the market that this valley between BARDA funding and commercial sales is real, and they are going to cross it, even if it costs shareholders a bit of equity.
Let's dig into the pain points that made that raise necessary. That revenue drop from $8.2 million last year to $3.8 million this quarter. How is that tied so directly to the BARDA contract winding down?
Well, think of BARDA as premium development money. Last year, they were deep in clinical trials, burning through cash on direct labor, sites, materials. And BARDA was reimbursing them at a great rate. But once you package all that data up and submit it to the FDA, that intense high-cost activity, it just stops. It winds down. You enter a holding pattern, and the revenue that came with that activity dries up. That's exactly what we're seeing here. It was planned, but it still hurts the P&L.
And that hit their margins too, didn't it?
It did. Gross margin ticked down a bit from almost 45% last year to about 42.7%. And again, it's the same story. It's a BARDA contract structure. A smaller piece of their cost pie is now that high-value direct labor, and that just naturally pulls the margin down in this kind of transitional phase.
So you have lower revenue, lower margins, and then you add in higher operating costs. I saw G&A expenses were up. That's how their net loss got so much wider. A loss of $3.6 million, up from $1.5 million last year.
And that jump in G&A is really telling. Management specifically called out costs for third-party advisors and consultants. Let me translate that for you. They are paying very expensive regulatory lawyers and consultants to make absolutely sure their de novo submission is perfect. That's a huge expense, but it's non-negotiable. You have to spend that money to get to the next stage. It really just shows you what regulatory execution costs.
Which takes us right to the second F of focus, the whole FDA journey. This is the key, the June 2025 DeepView de novo submission. So what did they say about their talks with the agency?
Very good, very frequent interactions. That's what they said. But here's the part that got really interesting, especially if you follow MedTech regulation. It's the status of their statistical analysis plan, the SAP, for the AI algorithm. Management said the SAP has been, and this is a quote, very favorably received.
Okay, break that down. Explain for the listener why that's more than just good news. Why is that such a huge de-risking event?
Because the SAP is the math. It's the rule book. For an AI device, the SAP is the document where the company tells the FDA, here is exactly how we are going to measure if our algorithm is accurate and effective. And for the FDA to receive that favorably means they're essentially blessing the method of measurement before the final analysis is even done. It means they're not going to spend a year analyzing data only to have the agency come back and say, sorry, we don't agree with the way you did the math. It shows the two sides are aligned on how to even evaluate this thing.
That's huge. That takes a massive amount of regulatory risk off the table. But they did mention some minor headwinds too.
They did, correct. There are ongoing talks about some additional testing. Things like human factors, reliability testing, pretty standard stuff for a novel device, honestly. And they did mention the U.S. government shutdown causing a general slowdown at the agency, which is, a problem for the whole sector.
But the key message, the thing they hammered home, was that they see no delay to the final clearance timeline, still targeting the first half of 2026.
And they have to stick to that timeline to keep investors on board. Which leads us to the third F finish, commercialization. Assuming they get that green light, the U.S. launch of DeepView is set for the first half of 26.
And what are they doing now in this waiting period to get ready for that launch?
They're using their international experience. They have units out in the world, and the feedback they're getting is, quote, overwhelmingly positive. And this is just a pat on the back. They specifically said the device is easy to use for both specialist burn surgeons and non-physician providers. That simplicity is absolutely critical if you want to scale up.
And that feedback is already going into the next version of the device, right?
Yes, exactly. They're already making small changes for the next iteration, which they're calling the Phoenix device. The fact that you're already working on Gen 2 tells you they feel pretty confident about the market's reception to Gen 1.
We should also touch on the handheld device. That's a separate project running in parallel, funded by the Department of Defense.
Right, and this is just a really smart strategy. The DoD funding is focused on military use cases, extreme temperatures, rough conditions. But here's the clever part. The main cart-based device is going through the de novo pathway. Because it's novel, there's nothing else like it. Once that gets cleared, it establishes a precedent. All that safety and efficacy data can be used to simplify the regulatory path for a handheld version for civilians later on.
So the big, expensive cart clears the major hurdle, and then the smaller, more scalable handheld can follow on a much easier, faster 510K pathway. A very clear long-term plan.
It is. And for the near-term finish, they're already laying the groundwork. They plan to use the relationships they built with the 137 U.S. burn units that were in their research. And they gave us specific numbers on the sales team build-out. 4 new full-time sales and professional education hires are budgeted for 2026.
4 people might not sound like a lot, but for a super specialized market like U.S. burn centers, that's a very targeted start. It shows they're starting to spend now before they even have clearance.
It's the first step.
Yeah.
So operationally, things are moving. But that transition still forced their hand on full-year guidance.
Right, the elephant in the room. They cut their full-year 2025 revenue guidance, dropped it to $18.5 million from a prior $21.5 million. And the reasons were the same things we've been talking about, BARDA timing and the government shutdown.
The key thing they had to sell the market on, though, was the caveat. They said they expect to recapture most of that lost revenue in fiscal 2026. That's the part investors need to believe.
But even with that recapture, they were pretty blunt about 2026. They called it the transition trough.
And that's a perfect term for it. They're saying that even with some revenue being pushed from 25 to 26, next year's revenue will likely be flat, or maybe even a little lower than 2025. Why? Because the money you make from the first year of a slow product launch just can't replace the fire hose of development funding they just lost.
So 2026 is the valley. The payoff, if you believe management, comes later. Real growth in 2027, 2028, once the product is actually out there and gaining traction. You have to believe in the regulatory story to get to the 2027 hockey stick.
You have to be willing to wait through that trough. And we should also mention the Spectral IP transaction with SimIP is supposed to close in Q1 26. So that will give them a bit of a financial boost in the numbers then.
So what's the catalyst map? What are the events that get us out of this trough?
It's all regulatory and commercial prep. Number one, obviously, is any feedback from the FDA and then the final clearance in the first half of 26. Number two would be the first steps of the U.S. launch. And then you're looking for any other non-dilutive funding, like more DoD contracts, to just keep extending that runway.
And all of this is happening against a backdrop where the med buff sector has been a bit soft, though healthcare overall has been stronger. So a bit of a mixed environment for a microcap like this.
Which is a perfect segue to our segment where we float an outrageous but plausible trade idea. But first, the full disclaimer. This is not financial advice. We are not financial advisors. This is purely for informational and entertainment purposes based on our read of the call. You should always consult with a qualified professional before making any investment decision.
Right. So here's the pitch. Here's the idea based on everything we just heard. Spectral AI is a thinly traded stock. Its entire value is pinned to a single binary event, that 1H 2026 FDA clearance. The financial miss and the guidance cut have pushed pessimism into the price right now.
Which creates what could be an inefficiency. The short-term numbers look bad, but the long-term operational certainty, or at least the confidence from management, seems really high. You have the favorable SAP news, the reiterated timeline, the financing is in place. So the price today seems to reflect the financial noise, not the regulatory signal.
So the outrageous but plausible idea is this. You initiate a calendarized long strangle using the furthest out-of-the-money options you can find, targeting a 2026 expiry. It's a pure volatility play.
The thinking is you're trying to exploit the potential for a massive repricing to the upside if they get FDA clearance. We're talking 100% plus move potentially. You can buy that potential upside relatively cheaply because of the current pessimism. And your downside is somewhat contained if the timeline just slips a little bit, because we are assuming, based on management's tone, that an outright rejection is a very low probability event. The timing is about capturing this window of maximum uncertainty before that 1H26 decision.
It's a bet on regulatory execution that's designed to capitalize on all the financial noise we've been talking about.
And that is the whole Spectral AI story right now. It is a classic regulatory pivot. You, as an investor, have to wait in. FDA clearance would represent in this really interesting health AI space.
So your key takeaway from this deep dive really should be to just stop looking at the Q3 revenue number and instead focus everything on the focus and finish parts of their mantra, the regulatory execution and the commercial prep.
The financials only matter to the extent that they prove the company can survive long enough to get there. The real story is what's happening with the FDA.
And that leaves you with a final provocative question to think about. If that clearance really does come in the first half of 2026, does a tiny 3.5% after-hours stock dip truly price in the risk and reward of that kind of binary event? Or is this just the calm before a potential storm? We hope this deep dive gave you the insights you were looking for on Spectral AI's latest call. Thanks for listening and keep digging.